enda chini juu tuonekana.
Aye. Amba.
Yeah. Capital. So hello learners, welcome to our session today. My name is CPA Aringo Frederick. So in our class today, allowed us to handle a very important concept. And the concept that allowed us to handle today, it cut across Cifa, that is Certified Investment Financial Analyst, Section 2. It cut across CPA, Section 2, and also for the students who are doing ATD, Finance, Public Finance and Taxation. So this concept, again, is not only for the purpose of our examination, but also is going to assist us when it comes to applying them practically. And the concept that you are going to handle today is a very important concept, commonly tested in both these levels. That is capital allowances. That is a capital allowance. Capital allowance, a very important concept, capital allowance. Talk of capital allowances. Capital allowance, also commonly known as capital deductions. Capital deductions. So this is a very important concept at this level. And as I've mentioned, it's not only for the purpose of passing examination, it's not only for the purpose of examination, but also for the purpose of us applying it in the practical field as accountants. So basically, whenever you're looking at capital allowance, most of the people, whenever they hear capital allowance, probably the concept of depreciation in financial accounting will kick in. Yes, it's very good to recall it with the aspect of depreciation, but also at the same time, you should get a clear difference that there are two different things. That is between capital and between capital allowance and also the aspect of depreciation. So that as that now, maybe we can introduce that aspect. Let us try increasing the focus. So we need to first of all understand the definition. I'll give you a structure of what capital allowance will look like. So first of all, always let us have form of this structure. I must understand the aspect of the definition. I should be able to know the definition of capital allowance. After we are able to understand the aspect of definition, also the keyword, I should also be able to know types of capital allowances. I should be able to know types of capital allowances. Of course, after looking at the types, we should also be able to understand the aspect of the rates of capital allowances. So talk of the rates. So these are the three main elements that we should be very familiar with. We should be very familiar with them. We should be very familiar with the three components. We should be very familiar with the three components. We should be very familiar with the three components. That is a rate, definition, and also that aspect of types of capital allowances, So that to do that, this is what you are going to handle. We are going to start with the definition. We are going to start with the definition. And I'm seeing some people are saying that they're not seeing it clearly. Let us try to adjust it. Just a moment. Upload. So that this is what we'll be having. So I've said you need to understand the aspect of definition. We need to understand the aspect of definition, types of capital allowance, and also the aspect of rate. So we can start with the definition. We need to clearly understand the definition of capital allowance. The moment you do understand the concept or the definition of capital allowance, you'll find that understanding also the other form of capital allowance will also be very easy for us. So maybe a good student will ask, Mwalimu, whenever you're talking of capital allowances, ideally in a simple definition, what can you say capital allowance is? So we normally say that capital allowance, these are deductions granted to investors, deductions granted to investors, deductions granted to investors on capital expenditures, deductions granted to investors on capital expenditures, deductions granted to investors on capital expenditures. That is a simple definition that you can give for aspect of capital allowance or deductions. You normally say that these are deductions granted to investors on capital expenditures. And who grant these deductions? Of course, it is the government which will be granting these deductions. So after we've understood the main definition of a capital allowance, the other element that is also very vital for us to have in mind are the types of capital allowances. So talk of types of capital allowances. Talk of types of capital allowances. So ideally, whenever we are talking of types of capital allowance, what should ring at the back of our mind? Number one element that we should never forget at any given point we are talking of types of capital allowance. Number one, we normally talk of investment deductions. We normally talk of investment deductions, commonly known as ID. Number two, we normally talk of industrial building deductions, industrial building deductions, commonly known as IBD. And also, number three, we normally talk of wear and tear allowances, commonly known as WTA. Also, we normally talk of another element known as farm work deductions, and also shipping investment deductions, So these are the main elements that you normally talk under capital allowances. You normally look at investment deductions, industrial building deductions, wear and tear allowance, talk of farm work deductions, and also the aspect of shipping investment deductions. These are very key for us to understand. And as I've mentioned, it's not only for the purpose of us passing the examination, because this concept is very practicable. Because whenever you, as an accountant at any given point, whenever you'll be preparing your draft accounts, your books to be audited, you must be having your movement schedule. You must be having your PPE, that is a property, plant, and equipment movement schedules. And in that event, you'll find that probably a company will be having its policy of depreciation. But when it comes to the aspect of capital allowances, we must always keep in mind the rates that are set there. And I want to be very clear on this concept. Currently, there's a confusion to many students in regard to the rates that have been amended of late. But for the purpose of examinations, which you should mark it very correctly, for the purpose of our tax exams, the rates that you are going to use are the rates for last year. Because any concept that you are going to be tested, if it comes to the aspect of rates or computation, ideally we normally base it on the last financial year, which you normally talk of, say like January to December last period. So any rates that have been amended during this period, it will not affect us in the coming examinations. And always mark that very correctly. The rates that have been amended, they're not going to affect us when it comes to these coming examinations. So basically, after we've mentioned that, and we've seen the types of capital allowance that we'll be talking about, I want us to start with the first one, investment deduction. Understanding the concept behind investment deduction and also see how we normally compute the investment deduction. And of course, we'll be looking further and talk of the aspect of qualifying cost, so that whenever we'll be talking of qualifying cost, you should always understand what it means. So having noted that one, we start with investment deduction being our first element. We start with investment deduction. So we are going to start with the investment deduction being our first element. We are going to start with investment deduction being our first component. So talk of investment deductions, talk of investment deductions, talk of investment deductions, investment deductions. So whenever we are talking of the investment deductions, my good student, what should ring at the back of your mind? What should ring at the back of your mind at any given point whenever we are handling investment deductions? What do you need to understand? So basically, what I want you to understand whenever you're talking of investment deduction is that we just be looking at deductions which are granted to investors who have invested in manufacturing industries. Keyword. In summary, we are saying that these are deductions granted to investors. These are deductions, of course, granted to investors in manufacturing industries, and at this point we'll be looking at machineries and assets used directly or in support of manufacturing, So basically, these are the keywords to understand that. Ideally, I'll be talking of deductions granted to investors in manufacturing industries. But say we are looking at the machineries and assets which are used in manufacturing. Either they are used directly or they are used in support of manufacturing. So these are the key words that you must always keep in mind at any given point. We are handling investment deduction. At any given point, we are handling investment deductions. These are some of the main elements that you must always keep in mind. So after we've understood the aspect of the definition of investment deduction, there is a very key word. There is a very key word that at least I'll want each one of us to have it in mind. We should be having it in mind because it's going to affect us in each and every component that we'll be handling in regard to capital allowance. And that's a concept known as qualifying cost. That is a concept known as qualifying cost. We should be very good on the qualifying cost. We should be very good in the qualifying cost to understand the concept of qualifying cost. So we should be having this concept of qualifying cost. I want us to understand the concept of qualifying cost. I want us to understand the concept of qualifying cost because, as I've mentioned, you will find that this concept, the concept of qualifying cost, will affect us in each and every capital allowance that we'll be handling. So we are talking of qualifying cost, this concept of qualifying cost. So, what I want you to note at any given point whenever we are talking of qualifying cost, what should ring at the back of our mind? Qualifying cost, ideally, we'll be looking at the cost that will qualify for capital allowance. Because I've already given you the definition of capital allowance, we've looked at the types of capital allowance. Now, whenever we are talking of the cost that is going to be granted capital allowance, is what you're terming it as what? Qualifying cost. So most of the cases, so always, whenever we'll be talking of qualifying cost, what you should recall is that these are the costs that are going to be subjected for capital allowances. Mark that very well. We are saying these are the costs that are going to be subjected for capital allowances. For capital allowances. Those are what you're terming them as what? Qualifying costs. Those are what you're terming them as qualifying costs. Now, I want us to look at the qualifying costs under investment deductions. What are these assets? What are these costs that are going to be subjected for investment deductions? What are these costs that are going to be subjected for investment deductions? Those are the type of costs that I want us to talk about in our class today. So we are looking at qualifying costs for investment deductions, qualifying costs for investment deductions, qualifying costs for investment deductions. So basically, whenever we'll be looking at these costs, because at the back of our mind is that now we know very well that investment deductions are deductions granted to investors who have invested in manufacturing industries. So looking at that concept, I want us to look at these costs which will qualify for investment deduction. And number one cost that you can talk about, under that you normally talk of the factory buildings. We normally talk of the factory buildings. The factory buildings. Talk of number one, factory buildings. That is very key. Talk of the factory buildings. Factory buildings being our number one. At any given point, whenever we're talking of a factory building, this cost of the factory building will always qualify for investment deduction. Will always qualify for investment deduction. Talk of number two point, we'll always be talking of what is known as the aspect of installation of processing machineries. Talk of installation of processing machineries. Installation of processing machineries. So talk of installation of processing machineries. Installation of processing machineries. And whenever we're talking of processing machineries, you can also talk of other machineries, processing machineries. Talk of number two, or rather number three, we normally talk of also the aspect of machineries such as weighing machineries. Weighing machineries. Talk of packaging machineries. Packaging machineries. Packaging machineries. And all other types of machineries that are used directly in manufacturing. All other types of machineries that are used directly in manufacturing. Then after we've talked of that, that should take us to number four. Number four, we normally talk of some of auxiliary costs or assets. Whenever you're talking of auxiliary costs or assets, ideally we're using, or rather we are talking of, in a case that if I don't have a certain element, what will substitute that? Say, for example, like when you're dealing in manufacturing, and probably you're using power to do your manufacturing processes. In the event that probably there's a power shortage, in the event that probably there's a blackout, what will be the substitute that you're going to use instead of electricity? These are the costs that we're terming them as auxiliary costs or assets. In the event that probably you don't have electricity, what are you going to use? Of course, in such a case, you're going to use what? Generators. And also in the event that probably you don't have water, maybe the taps have stopped running, what are you going to substitute instead of taps to consume the water? Of course, you can have such cases like boreholes, or we can talk of water pumps for us to pump our water into our manufacturing processes. So these are the costs that you're terming them as what? As auxiliary. So talk of number four, we'll be talking of auxiliary expenses. We normally talk of the aspect of machineries that are utilized for purposes, machineries that are utilized for purposes, machineries that are utilized that are utilized for purposes, machineries that are utilized for purposes, auxiliary to manufacturing, auxiliary to manufacturing, auxiliary to manufacturing, auxiliary to manufacturing, auxiliary to manufacturing. Such coasters, we can talk of water pumps. We can talk of the other concept like generators. We can talk of boreholes. We can talk of sewage systems. At times, some other people normally call it sewerage. At times, other people call it sewerage. So you're talking of sewage systems. Such cases, these are what you're terming them as auxiliary to manufacturing processes, assets. Also, such assets will qualify for ID. Also, we normally talk of, we can talk of conveyor belts. Conveyor belts, also they qualify for ID. Also another element, key element that you must also talk about, that is the concept of, we can also talk of the other concept known as perimeter walls or other assets. You can talk of perimeter walls. Some people call it security walls. We can talk of the aspect of parking bays. Talk of parking bays. EDC. So these are some of the elements that will qualify. These are some of the elements that will qualify for investment deductions. These are some of the elements that will qualify for investment deductions. So I want you to mark that very careful. The assets that will qualify for investment deductions, which you term them as qualifying costs. Also, after you talked of that, the key element that you must also be very good at whenever you are dealing with investment deduction is what is known as what? Rate for ID. Rate for ID. And also at this point, I want you to be very careful. Remember from last year, that is a period 2019, from 1st January 2019. Previously, we were providing ID at 2 rates. Previously, we were looking at the industries that are located in satellite towns and those that are located in major towns, of which we are saying that previously industries located in major towns, we are providing it ID at the rate of 100%. That is previously. Major towns, we are talking of Mombasa, we are talking of Nairobi, and we are talking of Kisumu. And we're also talking of satellite towns. We are also talking of satellite towns. So ID for satellite towns, we are providing it at the rate of 150%. Satellite towns, these are small towns, such as talk of, I'm not saying Mandera is a small town per se, but a good example is Mandera. We can talk of sites like talk of Tharaka-Nithi, if there's something like that. You can also talk of Voi. These small towns is what we're terming them as what? As satellite towns. So this is what was being provided, but now we don't work with that one. We don't work with the 2 rates. From 1st January 2019, for you to provide ID, all assets that will qualify for investment deductions, we are going to provide all assets at the rate of 100%, irrespective of where the industry is located. From 1st January 2019, all assets for ID will qualify for ID at the rate of 100%. Will qualify for ID at the rate of 100%. So please mark that very correctly. Previously, up to 2018, we were having satellite towns and we are also having the aspect of major towns. But from last year, 2019, all industries, irrespective of where they are located, ID is going to be provided at the rate of 100%. ID is going to be provided at the rate of 100%. So please mark that very correctly. Mark that very correctly. So after we've talked of the component of ID, the next concept will be what? How do we compute ID? That's the next question. How are we going to compute ID? So in computation of ID, we'll be having a very simple format to compute ID. So in computation of ID, this is what you are going to consider. This is what you are going to consider in computation of ID. So I'll be having the aspect of nature of the asset. I'll be talking of the nature of the asset. We'll also talk of the qualifying cost. I believe as of now, I've mentioned what qualifying cost is, and we'll also be talking of what? ID. We'll also be talking of ID. So in this case, assuming the nature of the asset, you are talking of the factory building. I'll term it as FB, not Facebook, but the factory building, FB. FB, in this case, assuming I'm having a qualifying cost there, ID, I know very well it's at the rate of 100%, so I'll be having the whole figure there. Talk of processing machineries, Also the same case, I'll be having my qualifying cost there, ID at the rate of 100%, so I'll be having the whole figure. Talk of conveyor belts, for example, So having that case, I'll just be having the same figure. I'll be having my total there. Talk of another element such as water pump. I also know that also the students for section 6 are gaining. Those who are doing taxation section 6, I know you're also learning something when it comes to the aspect of capital allowance, because this is also in section 6. This one is also in section 6. So after you do have that, I'm only interested with what? I'm only interested with ID. So this is what I'll be having as ID. That is what I'll be having as ID. So this is a format of how you can work out, the concept of ID. That's a format of how you can work out the concept of ID. So probably as at now, a good student will ask Mwalimu, probably we heard of something known as the 10% test. Or Mwalimu, probably we had been taught of the concept of non-qualifying items in ID. A good student will ask, we normally have a concept of 10% test. Mwalimu, how do you go about that? And probably also normally have the concept of the aspect of non-qualifying items in ID. Also, a good student will ask, Mwalimu, how do you go about the non-qualifying items in ID? That is very key also to note. But in that case, we are going to look at the concept of the 10% test and the concept of non-qualifying items immediately after we've talked of the investment or rather industrial building deduction. That is when we are going to look at the concept of 10% test and also the concept of non-qualifying items, so that you should grasp the concept very correctly. So up to this point, that will mark the end of the basic introduction of investment deductions. We've talked about the definition, we've looked at the qualifying cost, we've also talked about the rate and also how to compute the investment deduction. So after we've talked of that, the next concept that I want us to talk also about is also very key, and that concept is industrial building deduction. I believe and I know most of the students, even those who are in section 6, they normally have a problem in differentiating between the concept of commercial and industrial buildings. So that should take us straight for us to understand this concept known as IBD. I want us to talk of that concept known as IBD. The concept known as IBD. Concept known as IBD. I want us to talk of that concept known as IBD. So looking at IBD, what do we need to understand? Looking at IBD, what do we need to understand? So I'll have it here as IBD. We normally term IBD as Mr. Date. We normally term IBD as Mr. Date. Very key for you to understand it. Mr. Date. A good student will ask, mwalimu, kwa nini unasema IBD is Mr. Date? Why are you saying that IBD is Mr. Date? I'm going to give you that concept as we continue with IBD. So to understand that concept well, we normally say IBD can also be termed as Mr. Date. Can also be termed as Mr. Date. And I'm going to give you the concept why we normally term IBD as Mr. Date. I'm going to give you that concept. So basically, when you are looking at IBD, what must always ring at the back of your mind? That's the question that a good student will always ask him or herself. Whenever you're talking of IBD, first thing, what must always ring at the back of our mind? So IBD, ideally, we just be looking at deductions granted to investors on industrial buildings. Deductions granted to investors on industrial buildings. So we are talking of deductions granted to investors, deductions granted to investors on industrial buildings, And also, please, I want you to be very careful on this. Not only for your exam purposes, but also for the purpose of you preparing your books. Remember, June is almost here, and the companies are preparing their final books to be filed, the returns to be filed. So in such an event, and probably you're having a company which you are providing the industrial building deduction. So in such a case, what must you always understand? So I always love to differentiate these two for my students, for them to understand. Whenever we are talking of IBD, we'll be looking at two cases. We'll always be looking at industrial buildings. And also we'll always be talking of what is known as commercial buildings. We'll also be talking of what is known as commercial buildings. Always try to differentiate these two components. We'll also be talking of industrial buildings, and we'll also be talking of commercial buildings. So these are the two main elements that we must always be having at the back of our mind whenever we are dealing with IBD. So whenever you are talking of industrial buildings, what will you be talking about? At this point, I'll be talking of buildings such as what? I'll be talking of buildings such as warehouse, also known as godowns. I'll also be talking of elements known as staff clinic. I'll also be talking of what is known as labor quarters. Very good examples. Warehouse, godown, staff clinic, talk of labor quarters, talk of sports pavilion. So these are some of the good examples of industrial buildings. What about commercial buildings? At any given point, whenever we are talking of commercial buildings, always we must recall elements such as admin block or offices. We can talk of showrooms. We can also talk of staff canteen. So we have these two areas. Of course, this is where probably if you've done capital allowances, we are talking of non-qualifying items. We are talking of non-qualifying items in investment deduction. So I want you to mark this concept very well, and you should never forget or confuse ever again. You should never forget or confuse this concept ever again. So at this point, I'm having commercial buildings, and you do have what? Industrial buildings. So for commercial buildings, what is the rate for commercial buildings? The rate for commercial buildings, you normally provide them at the rate of 25%. We normally provide IBD at the rate of 25%, at the rate of 25%. So sorry, I know I'm on the dark. Just a moment. So we are seeing that for aspect of a commercial building, we normally provide IBD at the rate of 25%. And for industrial buildings, we normally provide IBD at the rate of 10%. At the rate of 10%. So commercial buildings at the rate of 25%, and industrial building normally provide them at the rate of 10%. And I've given examples here. We've given examples of what will constitute industrial buildings and also what will constitute commercial buildings. So looking at that point, now, why are we terming this IBD as Mr. Date? That should be another question that probably a good student will ask. Why are we terming IBD as Mr. Date? Why are we terming IBD as Mr. Date? So to understand this concept well, we normally term IBD as Mr. Date because of these reasons. When we will be providing deductions for items under IBD, we are going to provide deductions based on the period that they were in the farm. That is NB. NB. In providing IBD, we normally look at the period that when the asset was in the farm and when the asset probably it was used. Say, for example, a good case, maybe in this case, we had labor quarters. Maybe we had labor quarters. Maybe we had labor quarters. Maybe we had labor quarters. And looking at the labor quarters, you can say that we constructed the labor quarters, say, on 1st July 2019. That is when you constructed these labor quarters at a cost of how much? At a cost of 1 million. And I want to provide IBD on these labor quarters. So how are we going to provide IBD for these labor quarters? We are going to take, like labor quarters we've seen is at the rate of 10%. So I'll be taking my 10%, yes, we multiply by 1 million. Then I'm going to incorporate this concept of what? Mr. Date. We are going to incorporate that concept of Mr. Date. When did we started using this asset? The asset was used from 1st July, meaning that ikiwezekana hesabu na mkono, July, August, September, October, November, December, assuming that our financial year is starting from 1st January and ending 31st December. So July to 31st December, I'll be having 6 months. So in providing IBD for this labor quota, I should be having times 6/12. That should give us roughly like a figure of 50,000. So this is the figure, the 50,000. The 50,000 is the figure that we are going to take as what? As our IBD. Probably, maybe if we used this asset, say from May, 1st May, for example, 2019, the same figure at 1 million. Providing capital allowance. Ikiwezekana tumesema unahesabu na mkono kutoka May, June, July, August, September, October, November, December. How many months? 8 months. Providing IBD, talk of 10% times 1 million. times 8/12. That is the concept, or that's the main reason why you're terming that IBD as what? As Mr. Date. So please always be very careful whenever you are dealing with IBD, So that in our next class, we are going to look at the format of calculating IBD and also go ahead and look at WTA And also we'll be talking of the concept of the 10% test and also the non-qualifying items that you must always consider. Always remember, these video tutorials, you can always access them in our phone application, M-Darasa. If you go to your Play Store, search M-Darasa, we have two apps. We have the online and you have the offline. So the offline is going to assist you to study even without internet. You are going to study. You are going to watch these video tutorials. You are going to have the study notes even and study using without internet. And suppose you're using computer, just go to web.mdarasa.co.ke. You can also access our resources using there on that portal if you're using computer or laptop. So to that juncture, I want you to join me in the next session where we are going to handle this concept that we've left out, like WTA and also preparation of what? IBD. And also we'll be doing a question which was tested in our last sitting, November 2019, for tax students, section 2. November 2019, there is a question for capital allowance which was tested. We are going to look at that question. So to that juncture, thank you very much, and let us meet in the next session. May you be blessed. Thank you so much.